Welcome to Shred or Save. This video answers a common question. How long do you actually need to keep your tax records before you can confidently shred them? We've all been there. You're cleaning out a desk drawer and find tax returns from a decade ago. You pause, thinking, what if the IRS needs this? For the vast majority of taxpayers, the golden rule is 3 years. This is the standard period of limitations that applies to most tax returns. The IRS requires you to keep records for 3 years from the date you filed. For example, if you filed 2023 taxes in April 2024, you'd keep the records until April 2027. This is the period of limitations for audits or filing an amended return for a refund. However, there are exceptions. The IRS can look further back in specific situations, so it's important to know the different timeframes. Exception 1 is the 6-year rule. You should keep records for 6 years if you substantially underreported your gross income by more than 25%. When in doubt about income reporting, it's safer to hold on to those records. Exception 2 is the 7-year rule. If you claim a loss from worthless securities or bad debt deductions, you must hold on to those records for a full 7 years. For property and assets, you need to keep records for as long as you own the property, plus 3 years after you sell it. This helps prove your cost basis for calculating financial gain or loss upon sale. Finally, the rule for keeping records forever applies if you never filed a return or filed a fraudulent return. In these cases, the clock for the statute of limitations never starts. Here is a quick overview of the retention rules for different situations. Refer to this chart for a summary of how long to keep various types of tax documents. You don't need a mountain of paper. The IRS accepts digital copies. Scan your W-2s, 1099s, and receipts. Store them on an encrypted hard drive or a secure cloud service. Ensure your digital copies are safe from both hackers and accidents. Essential documents to keep include W-2s and 1099s, receipts and expenses, property records, and copies of your actual filed returns. The period of limitations is important because it is the legal window during which the IRS can audit your return, or you can file an amended return. Knowing this window helps you shred with confidence once it closes. Once your retention period has passed and your records are safely backed up digitally, it's time to shred. Don't let old paper pile up unnecessarily. Avoid common mistakes like shredding too early, ignoring property records that are needed until years after a sale, and relying solely on paper storage, which is risky. For small business owners, the stakes are higher due to complex deductions and payroll. You must keep employment tax records for at least 4 years after the tax is due or paid, whichever is later. When in doubt, consult a tax professional. A simple 3-step system keeps your digital records safe and organized. First, scan and organize your documents. Second, back them up to a secure location. Third, protect your digital files with proper security measures. Use this quick reference checklist for retention periods. Keep standard returns for 3 years. 6 years if income was underreported by more than 25%, and 7 years for bad debt or worthless securities records. Never discard records if you filed fraudulently or didn't file. In review, the standard rule is 3 years. 6 to 7 years applies to special circumstances. Keep property records until 3 years post-sale. Digital storage is your best friend for securely managing these records. Armed with these rules, you can clean out that desk drawer with total confidence. Know your window, back up digitally, and shred the rest. When in doubt, keep it 1 more year. It never hurts to be cautious with the IRS.